It's complicated. It's the root of all evil. It makes the world go round. Or is it? It's a fiction. It's just bits of paper and metal. Whatever it is to you or the vast economic world, and as the central banks, it plays possibly the biggest role in our lives. We depend on it for food, for housing, for the luxuries and entertainment. However, we also rely on it for the very basics of life, like water and heat. People starve and go without accommodation for the lack of it. But how is it brought into existence? Who creates money and why? Let's step into the world of finance. The money that banks create isn't the paper money that bears the logo of the government-owned Bank of England. It's the electronic deposit money that flashes up on the screen when you check your balance at an ATM. Right now, this money, bank deposits, makes up over 97% of all the money in the economy. Only 3% of money is still in that old-fashioned form of real cash that you can touch. Of course, the flip side of this creation of money is that with every new loan comes a new debt. This is the source of our mountain of personal debt. Not money that had been prudently saved up by pensioners, but money that was created out of nothing by banks and lent to people who could not repay. Eventually, the debt burden became too high, resulting in the wave of defaults that triggered the start of the financial crisis. In the following video clip, Professor Dirk Bezimer at the University of Groningen and Michael Kumhoff, an IMF economist, explain where money comes from in less than 2 minutes.
When a bank extends a loan, it creates money. Let's say that I want to buy a very expensive watch of 100,000 euros and I don't have the money. I can go to a bank and ask for a consumption loan. Now, if they're a good bank, they say no, that we're not going to give you the consumption loan to buy this expensive watch. But if they do give me it, they don't give me a bag of money. They will just take my credit card, my passport, perhaps there will be something done on a computer keyboard, some signatures, that's it, right? I walk away with a watch on my wrist, very happily, supposedly. Now, at this point, money has been created. This money didn't exist this morning when I got up and decided to buy the watch and take out a loan. That's new money, fresh money. That's how banks create money. Banks bring new money into the economy as they make out loans. Therefore, if you expand the stock of money, you also expand the stock of debt.
Right? Basically, the banks sit there, they wait for deposits to arrive, and if they have enough deposits, they lend them out to somebody else. And that is completely wrong. This is the wrong model of banks, because what happens in reality is exactly the opposite. And I've done this, I'm a banker, I know that that's how it works, and you can read it on many central bank websites, that's how it works. Is that banks, when they decide the economy is good, we are optimistic, we are now making loans, they don't need to wait for any deposits, because when they make a loan, they create the deposit. Right there, banks create money out of thin air.
Before 1844, only the government was legally allowed to create metal coins. By trying to keep metal coins safe or carrying them around was inconvenient, so people would typically deposit their coins with the local jeweller or goldsmith, who would have a safe. Eventually, these goldsmiths started to focus more on holding money and valuables for customers rather than actually making jewellery. They became the first bankers. In the next video, we hear direct from the horse's mouth just how the Bank of England creates money. And it's simply created at the touch of a button.
Ryland, your article is about how money gets created. We're surrounded here by gold in the vaults of the Bank of England, and historically in the gold standard, the amount of gold would have been related to the stock of money in the economy. Things are very different now. In the modern economy, where does money come from?
Well, let's start off with narrow or central bank money. As the name suggests, central bank money is determined by the Bank of England and consists of notes and reserves. And in normal times at least, notes and reserves are determined by the amount of notes that people want to hold or need for their transactions, and the amount of notes and reserves that banks want to hold given the level of interest rates in the economy. It is not chosen or fixed by the central bank, as is sometimes described in some economics textbooks.
Your article focuses on broad money. What determines how much of that there is?
Well, broad money, which in many ways is a better measure of the amount of money circulating in the economy, includes all the bank deposits of households and companies. And one of the key points of the article is that banks create additional broad money whenever they make a loan. Now, while this is nothing new, it is sometimes overlooked as the main way in which money is created, and it runs contrary to the view sometimes put forward that banks can only lend out deposits that they already have. In fact, loans create deposits, not the other way around.
Now, your article explains in more detail how lending creates money. It also explains how there are limits to how much banks are likely to create new money as a result of lending. These could be profitability considerations of the banks themselves, through to how households and companies react in aggregate to having increased deposits as a result of higher lending.
That's right.
So if banks create money through lending, what then is the role of the monetary policy of the central bank in this story?
Well, you mentioned some of the limits to how much banks will lend in practice. Well, monetary policy provides the ultimate limit. Now, in normal times, say before the Great Recession, monetary policy is set through interest rates, and that determines the loan rates that are faced by borrowers in the economy and the amount of interest that banks pay out to depositors. And this directly affects the amount of lending that goes on in the economy and the amount of broad money that's created as a result.
So obviously that's normal times. In the wake of the Great Recession, we've seen bank rate reduced to close to zero, and the Monetary Policy Committee embark on a series of asset purchases, often referred to as quantitative easing or QE, to stimulate the economy further. Now, your article discusses a number of myths relating to how QE affects the money supply. Now, QE serves to increase the number of reserves that commercial banks hold at the central bank. But the first myth you discuss is the idea that this in some sense represents free money for banks. What's wrong with that account?
Well, it's true, as you say, that QE will lead to an increase in the reserves that banks hold with the Bank of England. But if you consider what's going on the balance sheets of the parties involved, you can see that it's not really free money. The main point is that QE mainly involves buying government bonds from pension funds and other asset managers, not from banks. The pension fund in this example will receive money in their bank accounts, shown here in red, in exchange for those government bonds, shown in purple. The banks simply act as an intermediary to facilitate this transaction between the central bank and the pension fund. The additional reserves shown in green are simply a byproduct of this transaction. Now, while banks do earn interest on the newly created reserves, the key point is that QE also creates an accompanying liability for the bank in the form of the pension fund's deposit, which the bank will itself pay interest on. In other words, QE leaves banks with both a new IOU from the Bank of England, but also a matching IOU to consumers, in this case the pension fund. So in that sense, it's not really free money.
Also starting from the fact that QE increases reserves, the second myth that you discuss is the idea that these reserves are then multiplied up into additional loans, and this is what gets the economy going. Indeed, this is the essence of the so-called money multiplier theory of monetary policy and how that stimulates the economy, found in many economics textbooks. How is this account misleading?
Well, it's true, as we've discussed, that QE will lead to additional reserves held by the banking system. But banks cannot lend those reserves directly to households and companies. They have to make additional loans and matching deposits. And the simple fact of banks having more reserves will not materially affect their incentives to make lots and lots of additional loans to households and companies in the way the money multiplier mechanism that you mentioned would suggest.
So how does QE affect the economy?
QE affects the economy mainly through the extra bank deposits that pension funds and other asset managers end up holding. Those asset managers will use those deposits to buy higher yielding assets, such as the bonds and equities that companies issue. That will raise the value of those assets and lower the cost to companies of borrowing using those instruments. That's the key way in which spending in the economy is affected. But that could also mean that QE might reduce bank borrowing if companies use some of the funds raised by issuing bonds and equities to repay some of their bank loans.
The electronic numbers in your bank account do not represent real money. They simply give you a right to demand that the bank gives you the physical cash or makes an electronic payment on your behalf. In fact, if you and a lot of other customers demanded your money back at the same time, a bank run, it would soon become apparent that the bank does not actually have your money. For example, on the 31st of January 2007, banks held just £12.50 of reserve money in the form of electronic money held at the Bank of England for every £1,000 shown in their customers' accounts. Deposit money makes up over 97% of all the money in the economy, around £2.1 trillion compared to only £60 billion of cash. By volume of payments, bank deposits are used for 99.91% of transactions and transfers, with cash being used for just 0.09% of transfers. Consequently, the physical currency issued by the state has been almost entirely replaced by a digital currency issued by private companies. In other words, the UK's money supply has been effectively privatised. So as we can see, money in the form that we would normally identify as cash is worth exactly nothing, zilch, nada, zero. The economy that drives our daily lives is built on a sandy beach of guesswork, suspicion, chance, lies, and the hope that you never find out just how the banks have faked their own importance. So take some time to look into just where your wealth or poverty comes from. You may just think differently about money.